Hey there, investors. Welcome to Kruse Asset Management's Market Quarterly Outlook for Q2 and the rest of 2023. We got myself and John Brick here to provide our perspective on where we think the market's going, how to protect your portfolio, all that good stuff. So I'm going to step right into where the market has been, and I'm going to go ahead and share my screen. So I think here's a little chart of the S&P 500. And as we know, the market has been up about 7% year to date. But since the beginning of 2022, the market is still down. It was down 20% and then still fully down 14% from the beginning of 2022 where we reduced our risk. And the Qs are down even more. They're still down 20%. Even though they had a nice return in Q1. So all that's well and good, but where do we think the market's going to go from here? Well, let's talk about the economy a little bit first, and why we think we're possibly heading into recession, what Fed Chairman Jerome Powell is doing right now. So up here I have a chart of the the Fed funds lower limit rate. And as you can see, Fed was at 0% for quite some time and just started raising rates like madmen. And they continue to raise rates even though we've seen some signs of the economy possibly breaking with the bank failures. And the question is, why are we raising rates so fast? And why does he say that we need to stay high and persistent for longer than we might think? And here's what I think the answer is. The federal government, the Federal Reserve, has never been able to successfully fight inflation with their Fed funds rate being below the 2-year Treasury. So I'm going to have the 2-year Treasury put on this chart. So now the Fed funds rate is in orange. The 2-year Treasury is the line in purple. So what we saw was the 2-year Treasury was kind of hanging out pretty low, and then it started rising right through here. And this is when the Fed used that word, inflation is transitory. So they weren't really raising rates until it just kept being persistent. And then they said, oh, I've got to start raising rates. Now, the reason being is the gap between this 2-year Treasury and the Fed funds rate is inflationary. And in fact, it's inflationary in the system in the sense that the forces aren't felt for 6 to 9 months down the road. So this is, if it's not addressed now, you're going to have extremely persistent inflation down the road. So you have a big gap here. And so as the Fed starts raising rates, the 2-year Treasury continues to go up and maintaining that large margin between the two rates. So this entire area that you see between the purple line and the orange line is inflationary pressure built up into the economy. So as I said, we've never been able to successfully fight inflation with the Fed funds rate below the 2-year Treasury, which is what we've seen through here. We briefly got above it, but then the 2-year Treasury spiked again. So here we were, where the Federal Reserve raised rates 50 basis points last time, and people were debating about whether they should do it or not. And this is, I think, what the motivation is. We're still trying to get above that purple line. Now, you had 2 bank failures, well, maybe 3 if you want to count them all, but you said Silicon Valley Bank, Signature Bank, they failed. That creates a disinflationary force in the economy. So it dropped the 2-year Treasury pretty significantly, but to a point right now where there's a gap between the federal funds rate and the 2-year Treasury. And so it's just now that the Fed policies are starting to fight inflation. And so the reason why they're saying he needs to keep it higher for longer is he needs to make up this area on this side of the curve. So we need to continually keep this up. Now, if the 2-year starts falling, then he can start dropping that rates. But what he doesn't want to have happen is the 2-year stay up there and inflation stay persistent, because all of this hasn't worked its way into the economy yet. So those inflationary forces still haven't seen their full effect. So that's why Powell is saying higher for longer. And that's in spite of what the market's saying. And he's been a student of Volcker, which successfully fought inflation in the 70s and 80s. Okay. Anything to add to that, John?
I think you nailed it. I would just point out that, I guess we can get into this in a minute, but this 2-year chart, or the 2-year treasury rate, look at that drop off from 5% to 4%. That's not a bull market sign. That is the bond market telling you that there's problems brewing.
Right. And so kind of the definition of inflation is the velocity of money through the economy. The faster the velocity goes, the more inflation you might have, the more dollars are chasing goods and services. The reason why that was disinflationary and why it's kind of bad for the economy, somewhat what we want to see and why they're trying to orchestrate the soft landing was if the banks feel like they're in trouble, they're going to stop lending, which slows down velocity of money in the economy. So that's why this is a deflationary kind of event and somewhat helpful, but at the end of the day, we don't know all the fallout that's going to happen. Right. So here's the next little chart I want to bring up. Here is the chart of the S&P 500. Got some little lines on here in the Fibonacci sequence. If I have another dog, maybe I'm going to name him Fibonacci. But what we have is we have some highs back here, and then lower highs. You have a little bit of a higher high, and then you have lower lows. Here's our bottom that we saw. And the big debate is, are we going to retest the lows? And people are saying probably not. But we are forming what's called a head and shoulders pattern, an extremely classic head and shoulders. So you think about your shoulder, your head's a little higher and your shoulder's a little bit lower. So you have a high and then a neckline here, and then your head comes up with a little bit higher and then another neckline, and then your next shoulder, if it doesn't break through this last high, which it hasn't yet, then what you see is the next leg is down. And that somewhat coincides with the potential recession that we see coming in the next 3 to 6 months. So will we retest these lows? I don't know. But I do know that from a market multiple standpoint, we're still kind of expensive. So again, I'm going to bring in some more charts here. There's our friends from JP Morgan do a guide to the markets. So right now, here's our forward PE estimate. So we're kind of trading at 17.1. The long-term average is 16.8. Now keep in mind, most of this time is when inflation is at under check. It's very low. And we are at persistently high levels of inflation. As a matter of fact, I'm going to go to, from this page, inflation numbers at 29, page 29. So we are at higher levels of inflation than we haven't seen since the 80s, right? So that 20-year chart was with low levels of inflation, kind of this range. So if inflation is higher, you should have compressed multiples, not expanded multiples. So I would argue that if we're back to this page 5, that we shouldn't be at above average market multiples, we should be below average. And if we're heading into a recession, then that would cause earnings to decline too, and again, a reduction in the stock market.
And Stuart, let's point out that this graph from January, or no, I read that wrong.
No, I just got this out.
It's just March 31? Okay.
Yep. Just got it. Hot off the presses.
My apologies.
Hot off the presses. So that's where we stand right now as far as kind of some of these risks and why we think Powell is going to keep the interest rates up longer than higher, why the market is setting up for a potential decline. Now it looks actually kind of bullish. Everything looks pretty good. But if this does fall off, 2/3 of the market trades off of algorithms, so computers, programming, trading. So if they start seeing selling and this head and shoulders pattern is fulfilled, then they will sell into that anticipation. And if you sell into something, then you're creating more supply. More supply drops prices. That creates more momentum downward, creates more selling from the algorithms, more supply. It's self-fulfilling in a cycle. That's why markets tend to overshoot. It works on the upside as well, but we could be setting up for that downward decline. John, do you want to talk about some of the market risks that we have going on right now?
Sure. Yes, I do. And do you want to go back to the valuation graph real quick, just because I'll point to that? So all things you said, Yes, thanks. So in spite of us trading at above average multiples, we have a few identified risks on the horizon, which I'll talk about. I'll start with the obvious, and that's inflation. So in the 80s, as Stuart has alluded to now and in other webinars, Volcker had to get inflation down, and it took them a decade, and they did not fight inflation fast enough and strong enough. And Powell and the Fed, yep, there it is. That took a decade to calm. And you have the recession of 74, and you have the other bear market pullbacks in there. A decade gone. So Powell and the Fed and most market pundits realize that inflation is stickier for longer and it takes effort. And as a result, as what Stuart was saying, they're not going to just let off the brakes and just cut rates, despite the market pricing that in right now. So enemy number one of the market is still inflation. We all know that. But what happened yesterday, OPEC Plus cut production by a lot of barrels. Oil rallied 6%. So oil already structurally is in a long-term, I guess you could say bull. It has long-term fundamentals being very bullish. Banks aren't lending to it. Supply is down and demand continues to go up. Oil is long thought to have still heading back towards 100 from the 65 to $70 barrel it is today. So despite inflation being still high in the 6% range, I think 5.5 and 6% up there as of February, we think oil still has higher room to run, meaning inflation still is going to come back and be a problem, meaning rates are going to stay higher. So inflation, enemy number one. Oil prices staying high, enemy number two. If that's not enough, we have the Russian war still going on, and Russia is the second largest. For my memory here, it might have changed since the price cap and everything since the war, but they were the number two producer in the oil space, and they are still in a war. And what's worse is they're starting to team up with China and Brazil, and they're starting to have more reinforcements behind BRICS, all things going for higher oil prices and OPEC cuts, all part of that game. So geopolitical risk is still a big issue. And at some point, China may continue the rhetoric of taking over Taiwan. So if that's not enough, we just saw 3 banks fail. So we have 3 banks fail. Although that liquidity issue is pretty much behind us, so the market is telling us by rising 7% this year and NASDAQ up 20, we still think that there's issues on that front in terms of liquidity crunch. Banks are not going to lend as freely as they were. And so if we already had a tight liquidity and tight market because of higher rates, we just got a tighter economy because banks are not lending as much. Debt ceiling is coming up. That's not talked about yet because we kicked the can down the road. But by June, if we don't have resolution from the bipartisan discussions, we are going to have a big problem on our hands with the debt cycle. We have record levels of debt. Interest rates as a percent of the government income and GDP is through the roof, almost at all-time highs. And we are going to need to address that. And the likely route is to raise the cap, which hurts the dollar. There it is. Yep. Which also may have higher taxes embedded in it longer term. There's also a natural opportunity cost for the market. So why are people going to continue to buy stocks with all of these risks when you can park your money in treasury bonds at 4.5 to 5%? Very hard to rationalize putting a ton of risk on when you have treasury bonds that are essentially risk-free unless our government fails, which is not going to happen. So all things considered, I touched on a few things. That's all despite valuation being above average. So we think that there's a lot that can go wrong in this environment. And we don't have a graph handy, but Stuart and I, we've been talking about the earnings per share of the S&P basically being flat. And if a lot of these things start coming to fruition, more recessionary pricing and the banking issue gets worse, that's going to be a cut to estimates of the earnings per share, and that valuation is going to jump from 17 to 18 or 19 because your earnings drop. And there you go. So the market really is pricing in accelerating of earnings over time, which, all right, maybe, but if we're hitting a recession, we have tough times, inflation's back, consumers slowing down, oil prices are high, crunch everything. It's not going to happen. And so we're at a pretty expensive multiple. So I don't want to be a bearer of bad news. I want to just point out that you're not going to get multiple expansion at all, right? You're going to get contraction of the estimates down under that average on a lower EPS. So, I mean, there's still a lot of risk inherent in the market. Like I said, I'm talking about the risks, but we have a lot of positive things to say about what we can do for investors, and I do not want to scare people in any way. First, I want to point out that we've protected and are putting a lot of new money in treasury bonds. Like I said, 4.5% to 5% as a starting point. Very strong returns given they have daily liquidity, they accrue interest daily, and we have nothing but nice things to say about that setup for us. I also want to, let me see if I can share my screen here. We'll just stop sharing, please. I will share this. Can you see the graph of the S&P? Okay, great. So what I want to also bring up is that we've putting a lot of new money and a lot of diversifying, a lot of accounts we're starting to diversify with a lot of alternatives. And all of these alternatives on this sheet have been positive in 2022, some of them to the tune of 8 to 9%, like CNL here, FS Real Estate Debt Fund, Monroe Capital, and Priority Income. They were all positive last year, and we suspect that they can continue to give us a diversified revenue stream for income that's not tied to the market and don't have the same real risks that the public market has. And we're strongly pushing new accounts and existing accounts to allocate money into these alternatives. And so on that note, we will follow up with another email, but we are hosting a dinner May 18th for Chicago folks to come and listen to CNL Strategic Capital, Private Equity, and Real Estate Debt Fund, the Real Estate Debt Fund. On that note, I would like to talk about the Real Estate Debt Fund really quick to show that there's a lot of things to do with money. It doesn't have to be doom and gloom on the public side. S&P total return going back to 2018. Here you see a 16% drop because of the trade war we got in with China. In 2020, we have COVID, fell 30%, but quickly rebounded. A little bit of pullback, 10%, and now the debacle we're in now, down 20, 25. And this is the S&P, the NASDAQ was down far worse. Despite the volatility over the last 5 years, I would like to show you a fund, real estate debt fund that we've been using. Here's a real estate debt fund, as straight of a line as you can get. What this fund does is it lends term loans to real estate developers, apartments, and other parts of real estate, 2 to 3 year term loans, and they are priced off of LIBOR and SOFR. So as the rates stay higher or move higher, the income you get is higher. This is a 6 to 7%, 6.5 to 7% a year instrument. Dividends are paid monthly, and there's virtually very low rock bottom credit risk given the 3 periods of hardship you saw, and this line showing you the stability of the fund.
What's the lockup period and the minimums on this?
This is a $5,000 minimum, and the liquidity is monthly. So there's a little bit of a lockup where you have to sign in to subscribe and you have to sign to get out. It's meant to be an alternative with more of a, alternative exposure to buy into the LLC, or it's actually an LLP. I don't quite know that. I don't remember that off the top of my head. Whatever the fund structures, you have to buy in as any other alternative. But very, very low minimums and very high liquidity for something that can give you this much stability. And so there's a lot of things we're doing to give you better risk-adjusted returns. We could even show you our nice find of GE. Despite all this, we found some GE stocks. We can maybe show that to you. Anyways, I will turn it back over to Stuart for anything that I missed or you want to hit on.
Yeah, so another alternative that we were looking at and that we've done for clients across the board were some structured notes. If you could stop sharing, I wanted to point out how this structured note will line up with what we think is a good return profile. So this was a 3-year dual directional note. So what basically happened is we bought a note that is a 3-year note, and here's the payout profile. If the S&P is up at all in 12 months, you get a 14% return. Up 0.1%, up 1%, up 20%, you get 14%. If the S&P is negative after those 12 months, then it turns into a 3-year note. If the S&P ends up after 3 years also still negative and down less than 15%, you get a positive version of that negative return. So down 12%, positive 12. Down 2, positive 2. If it's down more than 15%, the first 15% is absorbed. So down 17, you only lose 2%. Down 20, you lose 5. So you can think about this. So far, you've basically, the only time you underperform the S&P is if the S&P is on fire and is up more than 14% in a 12-month period. Now, what we haven't talked about is if after 3 years the S&P is actually positive now, you have a leveraged upside. So again, you outperform the S&P 500. Leveraged upside to 150%. So if the S&P is up 20, you get 30. If the S&P is up 30, you get 45. So again, our premise is the next 12 months are going to be challenged. So this type of structured note lines up very well to what we think is the potential economic conditions. Now I want to share my screen and show you one more thing and tell you why we think this is going to match up with the profile here. So here's a chart of a bunch of the last, 9 recessions or so. So how you'd read this chart is the gray is a recession. This black line is the market low, and the purple is the unemployment rate. Now people are saying, hey, we can't go into recession because unemployment's so low, and it's true, it's extremely low. But let's look at these charts where the purple line hits the recession, and then that's when unemployment goes. Purple line hits the recession, unemployment rises. Look at every single one of these lines. It stays low until you get into recession. So just because unemployment is low now doesn't mean we're not entering a recession. Every single one of these lines, you have an unemployment spike because of the recession. Now again, let's look at the market results. So the greenish line is the S&P. So it normally bottoms sometime in the recession. Okay, so you're bottoming out sometime in the recession. Some of these are kind of flat and then a rise. So if our premise is we haven't hit the recession yet, and as you can see, this black line is usually in the recession or after, the market lows are still to come.
And Stuart, you can also point out that each time the market low has happened, the recession has been somewhere higher than the baseline, which is also what you're saying. But just to point out that unemployment hasn't increased yet as another piece of evidence. The recession hasn't come, and we have another piece of data, unemployment.
So think about that structured note. If we believe that there's a recession coming and we are going to have another leg down, but then a rally, almost every single time you see a nice rally after coming out of this recession. But we're going to have challenged future returns. So if we end up being kind of flat or slightly up, you get 14%. It doesn't seem like there's a big amount of risk that we're going to underperform and the S&P is up 30% in the next 12 months. I just do not see that happening. That's the only time this note underperforms. So if we do squeak out a positive return, you get your 14%. If after 3 years we've made it through the recession and you see this V-shaped recovery, you get leveraged upside 150% of the S&P returns. I love this setup compared to what are the probabilities of the market outlook coming if the past is any indicator of the future, and it does tend to be somewhat an indicator. So that's what we try to do here at Kruse Asset Management, is invest with the odds in your future, in your favor. We're trying to set up so that you will outperform given the economic conditions that we see coming. Anything else that we want to talk about? I think we were going to talk about the preferred. So why don't you talk about that? The preferred rate of return.
I do have, I could tag on what you were just talking about too, with the callable notes. We just priced one this morning at 15% callable for European indexes. And European indexes are 2 standard deviations. What was that stat we saw earlier? 2 standard deviation below the S&P. And have out. Yep.
This is the chart. So the European markets tend to trade at a discount to the U.S. market. About 15% is the average. They trade at a discount always. Not always, but tends to be. So here we are at almost a 30% discount to the U.S. markets. This is almost 2 standard deviations away from the long-term average. And any time in economics you get 2 standard anything, not just economics, 2 standard deviations away, you generally get a regression and a reversion back to the mean. So we would suggest that the international markets will, from a relative basis, outperform the U.S. markets in the future. And this would be supported by this chart. So what this is the purple mountains, you'll call it, are when the international markets outperform. And then the grayish mountains are when the U.S. outperforms. And you can see these are like a couple of years at a time, and they go back and forth, 3, 5, 1, 6. We're in a almost 15-year set of outperformance. And actually, it's funny because the last quarter, I was pointing out to the fact that every single one of these things ended at peak, because it peaks and then the beginning is outperformance. Well, this ended like this was kind of downward sloping. I was saying, hey, maybe we're at the peak right here. And so now this chart is saying this could be the very beginning of the international outperformance right here, which could last for a couple of years from a relative basis. And we've had 14 years of outperformance for the U.S. Doesn't mean the U.S. is not the better marketplace. It just means from a relative standpoint, which is going to do better. And it could be the international markets from this point on for a little bit.
All right. Last thing we want to mention was something else we found in all the market carnage, which has given us opportunity. So we have added to preferreds, and preferreds are basically not equity. They're not bonds. They sit right in the middle. So you have your equity, your bonds. Bonds are more safe, but you have preferreds right up here, and they're commonly used for banks to raise capital, and they're thought to be much safer than equity, but they still have equity-like trading volatility sometimes. And in light of recent banking events, a lot of big banks, Bank of America, JP Morgan, Citibank, and others have just been mispriced. And we have found an opportunity to add to an existing holding for bank preferreds. And the data shows that when the preferreds are trading at the levels that they are now, 1 year from now, on average, the total return is somewhere about 15 to 17% 1 year from now. And that largely is a function of the monthly dividend we receive at about 6 to 7%. I think it was 6.5 last time I checked, plus the total, plus the appreciation, getting back the appreciation you lost, or I guess the NAV you lost. All things considered, we have an ETF, so we're not taking individual bank risk. We're just taking sector risk, and we're buying at the lows. Total return expected of 15 to 17%. If we're half right and we get back 8 to 10%, plus including dividend, we think it's a very attractive place to be, and another vehicle that we're using instead of taking on S&P risk. So maybe we'll leave it with that.
Yeah, sounds great. So if you're talking the stock market on the golf course or in the grocery store or wherever you might be out and about in the world, in the wild, and some of your friends and associates are not talking about structured notes or the discounted value of preferreds or buying treasuries, we come across a lot of investment advisors that they can't even buy treasuries. They certainly can't buy structured notes. They just don't have the tools at their disposal that we do at Kruse Asset Management. So if you find that you're in conversations with some people that they do not understand any of the concepts, or their advisors are not doing these things for them, which they should be as a fiduciary, please make an introduction. We're happy to give them our portfolio review. We're happy to introduce them to our virtual family office so we can optimize their wealth from across many standpoints, from tax mitigation to portfolio optimization. So we're open for introductions to the right kind of clients. We love doing business with you, so we appreciate you tuning into our webinar. And this is Stuart Kruse and John Brick.
John Brick. See you later, guys.
From Kruse Asset Management. Thank you so much.